What's up, guys? This is Ace of Trades here, coming at you with a brand new video. This is the first part in the 4-part series on the very intro to options. If you already are a trader or you already know stuff about options, this is not a good video for you. This is for very beginners. Now, before I get started, please go ahead and leave a like on the video and subscribe with the notifications on if you haven't already. If you have any questions, feel free to leave them in the comments. Now, without any further ado, I'll get to the video. Now, this is the basics of options part 1 on buying calls. So, you probably are asking already, what are calls? Well, a call, if you don't already know, is the right to buy 100 shares at an agreed upon price by an agreed upon date. The date is known as the expiration, and the set price is referred to as the strike price. Now watch out, because if the stock is trading below the strike price at market close on expiration day, then the contract expires worthless. And the whole idea of this is very simple and easy to understand. When you think about it, the last day to exercise of option is expiration day. So if you have say a $22 call and the stock is trading at $21.50 on expiration, you should not use that call, because it would be cheaper just to buy 100 shares at the market price of $21.50 than to buy 100 shares at $22 using your contract. And a little bit more on that in a minute. But also, what is exercising exactly? Exercising is when you convert your contract into 100 shares and you pay the strike price for those shares. You give up all premium or extrinsic value when you do this. Premium or extrinsic value is any value that would be giving up when your call is converted into shares. This is sometimes called theta value. It might be called premium. It may be called time value. And in general, when expiration gets closer and closer, your theta value or premium will decrease. Also, if the strike price is higher, closer to the money if it's in the money, or further out of the money if it's out of the money, your theta value will increase because you have less and less intrinsic value. Also, premium will increase if volatility goes up. So if it is only moving like 1% each day, but then all of a sudden it starts moving 3 to 5% each day, then the value of your contract would increase due to theta value increasing with volatility increasing. Also, it's worth noting volatility goes way down after earnings. That's called the IV crush, which we won't get into at this point, but basically all you need to know is that value if the stock remains flat after earnings. Now here's a real life example of buying a call. At the end of a trading day in late October, Ford was trading at $8.17. Calls with an $8 strike price expiring in mid-January were trading for $81. It will be shown on your brokerage website as 81 cents, but this number must be multiplied by 100 because you're trading in 100 share contracts. So now, doing the math, you would take your strike price, $8, minus the amount it's trading above the strike price. And now if it's trading below the strike price, then you would need to add the difference. But anyway, so you would subtract 17 cents in this case, and then add the cost per share of the contract, which in this case is 81 cents, to make your break even at expiration of $8.64. And you can do that math with any options contract with any stock. It's the same formula, which is strike minus the difference of the current shares price and the strike price plus the price of the contract. here's some different possible scenarios on expiration. So say by January, Ford rockets up to $14.23. Your break-even was, of course, $8.61. The shares per contract were, of course, 100, which leaves you with a net profit of $562. Now say Ford rises to $8.67. That would leave you with a nice profit of $6 off your $81 investment, which is a pretty decent return over that time. But now say Ford goes up to $8.25, but it does not go up enough to combat the decline in time value. Therefore, you'd be looking at a loss of $42. Now here's our last example of if Ford went down to $3. Alright? You can never lose more money than what you invested. Therefore, despite the rapid decline in share price. You can also choose to close the contract early by selling the contract. That will allow you to lock in gains and maintain some theta value. Now here's some different risks and benefits of buying calls compared to just buying shares. If the stock goes down, this is risk number one, a call goes down substantially more. If the stock stays flat over time, your call loses value. Like for example, when Ford went to $8.25, even though the stock went up, we lost money. Now the next example would be that calls have expiration dates in. Basically, if you own shares, they never expire. So in theory, it could go all the way down and keep going down. But if one day, in say June, it shoots up, you would still make money, but you would have already had your expired worthless and would have been looking at a loss with your January expiration. And that brings me to the fourth risk. Calls can become worthless. Now technically shares can too, but there is a much, much higher chance that calls could go worthless than shares. Now the final thing is there is substantially less volume of calls sold than the stock. So getting a good price when buying or a good sell price when selling can be difficult. For example, I was looking to trade JB Hunt. It was in one of my previous videos, but there was good fill opportunity due to wide bid-ask spread, which a bid-ask spread, for those of you that don't know, is the difference between the price somebody's willing to buy it at and the price somebody's willing to sell it at. You want that to be nice and tight, because that means you can get a fill at a good price fairly easily. But if it's wide, then you're more likely to have to get a poor price right out the gate, and then get a poor price when you make options on certain stocks impossible to truly trade easily. Now here's one of the benefits. Potential profits are much higher than just buying the stock. We'll get on that in a minute. But basically, since you're trading with 100 shares, but you didn't pay nearly what you would have to pay for 100 shares, your potential profits are higher. Potential losses are less than if you straight out bought 100 shares. So, like, if you bought 100 shares of Ford and it went down to $3, you would be looking at a loss of $517, and that would be terrible. But if you bought the call, you would only be looking at an $81 loss. You can also choose between different expirations and strikes that's best in what you believe the stock is going to do. Also, this is just like a bonus one. It's not too serious, but calls are more fun to trade as you can make more while risking less. You can also use more advanced strategies, and we'll get on those in later videos, that involve buying calls, selling calls, and also messing with their counterpart, puts, which we'll have in a very soon upcoming video, to make profits in all sorts of different scenarios. So this can be very simple, or it can be very complicated. And that's one of the benefits to trading with options rather than just trading with shares, because there's not as much you can do with shares in situations like ones we'll get into on later videos. Now here's comparing calls to shares. So what I have is a chart right here. And we compared the $8 call, which was trading at $81, to 10 shares, which is approximately the same. It would cost you like $81.07. So you would basically get 10 shares for what you would pay for the same price. And as we can see, you would lose money more with calls, but you would also make more money with calls. And this chart really just illustrates what I've already discussed. Now, as it goes lower and lower, you would lose more and more with the shares, but you would cap your loss at $81 already, because if it trades for $81 loss. Meanwhile, to lose $81, you would have to have Ford go to zero, which it's probably not going to do in that time. But it is somewhat likely to be trading under $8, which would cause you to suffer max loss. But now at the same time, we see the crossover at about $9.70 or so, and that's when owning a call will really benefit you to shares. Like if Ford goes to like $16, you would have basically doubled your money. You would be looking at like around $150 to $160 if you bought shares, which is great performance. That would be awesome, which Ford is probably not going to do that, full disclosure, but if it does, you would have doubled your money. However, with calls, you would be looking at, well, shoot, I mean, you'd be looking at over a $700 gain off your $81 investment. So I hope this chart really illustrates that to you, about how you can truly make so much more with calls, but you can also lose a lot more, a lot easier. Now, thank you for watching this video. I do encourage you to subscribe and to like the video if you learned anything. Coming soon will be part 2 on puts. Thank you for watching, and have a good rest of your day.